Well, hello everyone. Welcome back to Finspire's Focus on the Markets Masters Edition, second quarter 2026. Yes, I have my green jacket. We're ready to go. And yes, I'm actually coming to you from Augusta, Georgia. In the first quarter, we did an interview format to kick off the year, and so much has changed in the investment backdrop. And we're happy to get into the material this quarter. But here we go. We'll have a lot of Masters trivia, maybe some Masters ideas thrown out there as we move along. But first, the disclosures. Masters are known for their incredible azaleas and other plants that they have around their course. Wanted to make sure that we're going to share not just facts, but also our opinions, of course, on what is happening in the economy and in the market. So how do you do this? The Masters, they're known very much for their caddies who wear those big white, I call them onesies, but big white uniforms. And you need a really good caddy at Augusta to win the Masters. And you feel like you need a really good caddy right now to navigate the economy and the markets because there's a lot going on. And everything, of course, changed. The investment backdrop completely changed during the war. So we're going to get in. Yes, we're going to have fun with this video. But in the second, really in the last third of this discussion, we're really going to get into some of the risks that the war in Iran has created. One of those is the higher energy prices. Look, higher energy prices sustained for long term are going to be a challenge to the economy. They're going to be a challenge for lower income individuals. Lower and middle income households are going to feel the biggest part of the pain when it comes to higher energy prices, but also businesses might run into a significant issue with higher costs of energy, especially with things like diesel fuel, which really transports everything across this country. It could result in some very strong and higher short-term inflation. And that being with an economy that was already mixed. In fact, we're going to get a little bit into this, and that yes, fourth quarter GDP growth was positive, but barely at 0.7%. And some of the recession probabilities rose during the Iran conflict here in the month of March. Look, as a result, fewer jobs have been created. That puts the Federal Reserve in a tough spot when you have higher levels of short-term inflation and also jobs receding from the economy, even though that turned out not to be the case in the month of March. It was the case in February. It puts the Federal Reserve in a very tricky spot because interest rate cuts were expected later this year, and now it's a question mark as to whether we get those interest rate cuts, short-term interest rate cuts later this year. Markets, all right, look, wars and conflicts, markets have been able to handle those over the years. In the 59 global crisis events since 1907, the S&P was down on average about 7%, taking a few months to recover. There are a few unique aspects to this, although we don't envision this to be the same as the Arab oil embargo in 1973 or a financial collapse like we saw in 2008, 2009. We see some significant challenges to the economy ahead, and how that impacts the markets, especially in a midterm election year, is something that we're going to see play out in 2026. Bonds. Bonds were also tricky because short-term and medium-term rates rose. The 10-year yield actually moved higher, which put some challenges to total returns and fixed income in the first quarter. So the bottom line, when it comes to investing in portfolio management, we're valuing diversification like we have the last few years, which has worked very, very well. Quality and liquidity. In this environment where you have very volatile markets, we could have sustained volatility for the next few months, especially in a midterm election year. I'll come back to that at the end. Look, those are the areas that we're emphasizing from a portfolio management standpoint. All right, let's look at the geopolitics. Clearly the story of the first quarter, story of the world right now, especially since March kicked off. Look, these short-run inflation spurts can happen in these energy price shocks, these commodity price shocks, and it's likely to play a significant role in the midterm elections. It just is. Someone's always to blame in politics, right? And that's something that we're going to hear a lot about: higher prices, higher energy prices, where was the controlled inflation, et cetera. But what I'm also concerned about is after the war is over. Yes, perhaps there's, let's say the U.S. pulls out of direct conflict over the next month or so. What does that mean afterwards? What does the picture look like afterwards? And that's where I'm a little bit concerned about foreign investment coming into the U.S. I'll talk a little bit about that, but a lot of AR projects which require trillions of investment, both domestically and from overseas investors, I think is maybe a little bit at risk here. We'll talk a little bit about that as we move ahead in the presentation. All right, so what exactly happened in the first quarter and the way the markets played out? Commodities led the way. Okay, so diversification remained very important. Commodities led the way. Small caps were barely positive. Bonds were basically neutral, zero. And then you had negative returns. In fact, the S&P 500 was the worst performing asset class in the first quarter of the year, negative 4%. And we highlighted here the white dogwood, hole 11 at the Masters course at Augusta. It's the toughest hole on the course. And each of the holes is actually named after a different local plant. So the white dogwood, which is hole 11, which is actually the beginning of Amen Corner. So as you can see, it plays the toughest of the holes at Augusta, and it just looks pristine but tough to play. All right, let's move on to what's happening in sector returns, and this is where things look really distorted. Because of the big ramp up in energy prices, energy futures prices and commodity prices, energy companies did exceptionally well in the first quarter. You're looking at this correct. Energy stocks on average was 37% in the first quarter. Materials, so anything commodities related did extremely well. Commodities, energy related. Things that didn't do so well, you can see on the right half of the page here, whether it's technology, financials, communication stocks. So some of the, quote unquote riskier sectors or growth-oriented sectors, if you will, of the markets did not fare well, especially post the war beginning in the month of March. Now, we highlight here on hole 13, we took a picture of Rays Creek. Rays Creek is a famous creek at Augusta that rolls through a few different holes, and it is tricky, right? We've seen numerous players have their balls get stuck, even though it appears to be like a pretty skinny or narrow creek. It creates, being so near the green like that, it creates some interesting navigation points, just like these sectors. So don't always fall into, I should say, the rally that is the energy price stocks. Yes, we don't expect 37% returns for the whole year. That could moderate itself as markets get a little bit closer to back on track once the war is over, or at least when the U.S. pulls out of the conflict itself. Here's the conflicting area with the economy. There's something called the ISM, Institute of Supply Management, and anything over 50, which is then that dashed line across the page here, indicates that that area of the economy is expanding. And the Institute of Supply Management really splits the economy into two: manufacturing and services. So manufacturing and non-manufacturing, to be more technical. Well, one of the very interesting things that's occurred in manufacturing the last 2 months is a big spike up in output expansion in the manufacturing sector, something we haven't seen of this magnitude really since August of 2022. And the service sector, or the non-manufacturing area of the economy, has been well into expansion territory for quite some time. So how is this possible? How are we having 0.7% economic growth, GDP growth in the fourth quarter, but also seeing significant expansion by the Institute of Supply Management, or the ISM surveys, across services and manufacturing activity? It's a puzzler. Now, it could be related to government shutdowns. We're in the middle of another mini government shutdown. I'll talk more about that as we get towards the government risk section of the presentation. But this is something that is incongruent with GDP growth at 0.7%, which you see here. Okay, so we call them growth components over time. It's broken up quarter to quarter. The fourth quarter was 0.7%. We highlighted Rory McIlroy here, who it took him a lot of mental growth to win the Masters, and he finally broke through in 2025 to complete the Grand Slam of golf, which is winning the 4 major tournaments of golf, and the Masters was last one for him. That was very evasive, but he pulled through finally in 2025. So maybe the economy will be just like Rory McIlroy in 2026. We'll see. All right, unemployment and wage growth. Look, we had very poor jobs numbers in the month of February, and then just as things were projected to be very poor in the month of March, they came out very strong. So over 170,000 jobs reported, new jobs created in the month of March. That was a very welcome news to the market. It also pushed interest rates a little bit higher. But one of the things that was underneath that, one of the numbers that was underneath that, was that wage growth. You can see in this sort of orange gold line here, actually fell down again to about 3.4%. And that's a pretty strong number. It's a good number for inflation purposes. It's also a good number for corporate earnings, which we'll talk about in a moment. One thing that hasn't really grown in inflationary pressure are prices of sandwiches at Augusta at the Masters tournament. For a lot of sandwiches, a lot of snacks you get for as little as $1, maybe $2, and they've kept it that way for a long time. It's quite an interesting tradition, quite an interesting tournament tradition here. All right, jobs are being created. Yes, we're at war. Yes, there's still decent wage growth, but there's a lot of uneasiness around there. In fact, consumer sentiment and expectations on future sentiment of future conditions, I should say, survey done by the University of Michigan for a very, very long time. And you see here, this is almost a 50-year chart of data. It's at one of the lowest levels it's been in 45 plus years. We're talking about levels that are as low as they were during the Great Financial Crisis, post-Great Financial Crisis in 2009, 2008, 2010. That's really something. So people are feeling very uneasy about the economy, and then of course these latest data points certainly come during a time of war. Greg Norman is highlighted on here. Now, Greg Norman had. It's one thing to be consumer sentiment, but I got to tell you, Greg Norman's sentiment at the 1996 Masters here at this picture blew a 6-shot lead to lose the tournament that year. And yeah, his sentiment wasn't feeling so well in 1996 of this tournament. But consumers these days are feeling very lousy. They're very uneasy about what's happening, not just in the economy, but globally, and how that will impact, in particular, this artificial intelligence movement. How it impacts them individually is creating a lot of unease and a very sour levels of consumer sentiment. All right, let's talk about earnings. We talked a little bit about the impact that high energy prices can have on detracting from corporate earnings. Yeah, well, stocks in the S&P 500 were already on a collective whole expensive going into the year. They've come off those high levels, even though we had pretty strong earnings growth in the fourth quarter. So will we have that again in the first quarter? We'll see as we start to get earnings reports starting next week reflecting first quarter 2026 results. What we do know is this is one of our staple charts here that we see. And we look at quarter to quarter, the movement of the S&P 500 in the jagged line, the earnings mountain in the blue earnings mountain in the backdrop basically says whenever stock prices get above that blue earnings mountain, they're typically overpriced or at an expensive level. We were at that level to start the year, and now we've come down because we had positive or actually pretty strong earnings in the fourth quarter, and stock prices actually came down in the first quarter. So now we're in a slightly less expensive world today. In fact, we're at a level in valuation that we haven't seen since 2020. And I'm highlighting here the 2020 Masters leaderboard that Dustin Johnson won. That was the year of COVID. Dustin Johnson went on to be part of the LIV Tour, which is the competing golf tour to the PGA. What's interesting about that year's Masters, it wasn't played in April. It was actually, like it is every year, it was actually played in November for COVID-related reasons. So very interesting. We haven't seen prices of the economies like this, prices in the markets since 2020. They're still high, they're still elevated, but they're not as expensive as they were to start the year. And if we get another good quarter, 2 or 3 of earnings growth, then we should have a strong rebound in the equity market at some point later this year. All right, just a very simple chart here. Let's get serious because, yes, golf is fun and beautiful, and the Masters and Augusta National are pristine. But there's a lot going on in the country right now, especially a lot going on in the world, especially with the war in Iran. So there are clear risks that are threatening not just the economy, but also then the markets. One is gas prices. We talked about energy prices already. This is a very simple chart about gasoline. This was as of the end of the quarter, end of March, gas hovering around $4 a gallon. You can get certain pockets of the country where you have diesel fuel as high as $7, $8 a gallon. And this is all due to that Strait of Hormuz tightening up, that very slender area of waterways, global waterways, where actually 20% of the world's energy is passing through. It's creating all kinds of disruption in the energy market. Gas prices, which were close, or oil prices for a barrel of oil was hovering around $65 or so going into the Iran conflict, is now, depending on the day, around $100 or $100+ a barrel of oil. That's a massive increase. We're talking about 50% increases in a barrel of oil, and that's now trickling through into gas and diesel fuel. Look, this is a direct threat to the economy, no doubt about it. When you have consumers paying energy companies for fuel instead of energy instead of having that go towards other forms of economic development, it usually slows down the economy. And certainly the longer the conflict goes, the more difficult it becomes on the economy, especially with higher energy prices. And here's another wrinkle to the equation. Because of the energy prices, we're getting now some mixed signals from the Federal Reserve about whether interest rates, short-term interest rates, are going to have 2 more cuts as expected later this year. Well, I'm going to get a little bit technical on you here for a moment. And if you look at the shorter end of the curve over here, so short-term maturities, the far left here is where the Fed controls short-term interest rates. And then you have two 10-year yields, 30-year yields all the way out here on the far right. So time is moving on the horizontal axis. Look what's happened just in the last quarter with shorter term yields. You can see the 2-year yield popped up to 3.79% after being down a little bit below 3.5%. So this is creating a huge challenge. A lot of that's because of short-term inflation expectations. Kevin Warsh is walking in potentially as the new Federal Reserve Chair in May. We now have reports from Jay Powell directly, or not reports, comments from Jay Powell saying he may not leave in May, may just stay on the committee. Look, we could be running into some very politically charged conversations at the Federal Reserve, and that puts short-term interest rates in a big quagmire going into the second half of the year. All right, here's one of the big areas of our concerns is reinvestment in AI in the U.S. The Trump administration, President Trump made a lot of announcements in the first year of his administration, saying that he's been attracting all this capital, trillions of dollars of capital from foreign governments and domestically into the U.S. for AI-related projects. Well, this war is going to cost a lot, and it's going to cost a lot not just in dollars here for U.S. taxpayers and for the U.S. government, but it's also costing other countries some cause for concern and dollars as they start looking at and evaluating their own self-defense. So if you take a look at Saudi Arabia and the UAE, United Arab Emirates, they were the top 2 in the form of announcements that they were going to send hundreds of billions of dollars into AI projects in the U.S. Well, given the war, they may need to replenish their own national defense, and their reliability of being strong U.S. partners, although I wouldn't say is in doubt, is a little bit in question whether or not they can redirect those dollars, those sovereign wealth dollars, back into the U.S. for AI projects as opposed to working on national defense projects within their own country. Same is true in Japan and South Korea, the 2 flags on the bottom there. Japan and South Korea were also amongst the top 4 countries of sovereign countries, sovereign investors in these AI projects here in the United States. Well, Japan and South Korea now, with a very hot world, if you will, are now on higher alert, even higher alert than they already were about China and whether or not they will get aggressive in Taiwan. And they may need to protect their own national defense. And those dollars, I'm concerned that those dollars may be directed into their own countries domestically, perhaps for national defense, as opposed to AI projects in the United States. I would say that's somewhat at risk as we look ahead here in the second half of the year and the impact that the war in Iran has. The other impact here is Pentagon funding. We were starting to make some progress in the federal budget deficit this year. We were starting to, and I know it doesn't look like it. We were still running about a $1.8 trillion deficit at the fiscal year ended September 30th, 2025. We were moving in the right direction in this area. And now, naturally, the Pentagon and President Trump himself the Trump administration is asking Congress for hundreds of billions of dollars worth of Pentagon funding to resupply and to fund the war overseas. This is a direct threat potentially to interest rates. Interest rates did have some lower pressure to them. They could have had lower pressure if we end up with a significantly improved budget deficit for fiscal year end 2026, September of 2026. But I think a lot of that has been sidetracked by the cost of the war and everything that comes along with it. So government spending is another risk. Government composition is also another big risk to the markets, and the markets don't like these midterm election years. They're some of the least performing in the markets during history since 1933. Why? It's because we have such a narrow House majority for Republicans today, and a modest majority in the U.S. Senate. All of that is up for grabs in the midterm elections this November, and the war further complicates higher energy prices and higher perhaps short-term inflation figures is really going to complicate the election cycle for Republicans. What does that mean? That means that you could have a changeover in elected representatives. You could have a changeover in policy. You could actually we could actually find ourselves in like a 3-year hold on policy changes if Democrats take the House and the Senate, with Republicans, of course, in the White House. You could have a complete logjam, policy logjam there. Gridlock is the word I'm looking for. And markets actually like the gridlock, but they won't know there's gridlock until later this year. So typically midterm election years are sluggish, leading up to, say, October. And then once these elections are behind us, we tend to take off. And again, some of that's going to be dependent upon the movement of what happens overseas. All right, we want to extend a big thank you to you for listening. We know that we've heard a lot from you all, that these videos are something you look forward to and like to receive. So we hope to give you this type of quality content. Look, we're in an interesting spot right now. We had a really good start to the year in January and February. We had a not so great March. The war is going to dictate, and what happens in the short run here over the next few months. And then all eyes are going to be on the economy and on the midterm elections come this fall. Thanks so much for watching. We'll catch you soon. Catch you next time.